Oil de-escalation hopes changed the tone of this week. Welcome back to the weekly market recap. The move was not built on a finished peace deal. It was built on the idea that energy supply risk may be easing. That matters because crude is the inflation channel. When oil cools, yields can ease, discount rate pressure can relax, and buyers get room to lean back into risk. But the Fed backdrop is still not clean after hawkish minutes kept cuts harder to justify. So the question is simple. Are buyers confirming a real risk on rotation, or are they just reacting to temporary relief in oil and bonds? That is why the chart read matters now, because price still has to confirm the story instead of just borrowing strength from headlines. The Dow Jones Industrial Average closed above 50,500 and gained a little more than 0.5%. And that matters because the breadth side of the tape is still participating instead of leaving the rally only to tech. The S&P 500 finished around 7,470, up modestly, and that is the broad market decision layer. Buyers are still in control, but they need the close to keep validating the move. The Nasdaq Composite also closed higher, but only slightly, above 26,300. That tells you growth is helping, but leadership is not running away from the rest of the market yet. VIX stayed under 17 and barely moved lower, so stress is not building. That helps the bulls, but low volatility only matters if price keeps holding the breakout structure. Bitcoin slipped towards 76,000 and lost more than 2%, so speculative risk is not fully confirming the equity strength. For me, that is a yellow flag, not a bear signal by itself. Here is the decision block. If oil keeps easing and yields stay contained, then this rally can keep rotating beyond the mega caps. If crude snaps back higher or yields reprice upward again, then this becomes a much more fragile breakout attempt. So we start with the broad index chart first. I want to see whether the S&P 500 is confirming relief, or whether the market is quietly setting up for a rejection. SPY still has a healthy long-term trend underneath it, so I'm not treating this as a broken market yet. The Golden Cross regime is still intact, and that keeps the bigger structure constructive, even if the next move is a pullback first. The 50 days moving average remains above the 200-day moving average, and both lines are still rising, so sellers need more than one soft reaction to change the broader read. But price is stretched well above the 200-day moving average, and that is why I do not want to chase this into resistance without confirmation. The actionable read is more cautious here. Price is trading in the middle of the current support and resistance structure, not in a clean breakout. The resistance line is the problem. Until buyers reclaim that area cleanly, I still lean toward rejection before the next better upside attempt. The support line is where I want to see whether the pullback gets bought or starts to turn into something deeper. RSI is still constructive above 50, so the bull case is not dead. It just needs price confirmation instead of another weak push higher. MACD is slightly negative but improving, which tells me selling pressure is cooling, not fully accelerating yet. A quick volume check matters here because participation is quiet, and that keeps me from calling this a strong confirmed breakout. The macro backdrop fits that hesitation. Oil relief helped risk late in the week, but hawkish Fed pressure and elevated yields still make the S&P 500 prove the move. If buyers reclaim resistance, the pullback first read weakens fast. If they fail there, I am watching for sellers to press price back toward support before we judge the next bounce. QQQ is still the leadership chart, but it is leadership with extension risk now. The Golden Cross regime is intact, and that keeps the larger Nasdaq trend bullish rather than broken. The 50 days moving average remains above the 200-day moving average, so sellers still have to prove they can do more than interrupt the trend. The issue is distance from the 200-day moving average. Price is far above that long-term line, so I want confirmation before chasing growth at the top of the move. Last time QQQ was the stress test for risk appetite. That stress has eased enough for leadership to recover, but it has not removed the need for a cleaner pullback or a stronger breakout close. The trading red is not clean bullish yet. Price is around the middle of the current support and resistance structure, so this is still a decision zone, not a free runway. The resistance line is where buyers have to prove this is real leadership and not just a stretched push into a cap. If that reclaim fails, the support line becomes the first area where I expect sellers to test whether growth can hold the broader market together. RSI is above 70, so momentum is strong, but it is also hot. That supports the trend, but it also raises the risk of a pullback first. MACD is fading below zero, and that is the warning. Buyers need price confirmation before I treat this as a clean continuation setup. If you look at the volume, I will show it briefly. Participation is quiet, so this move still lacks strong confirmation from buyers. The macro piece matters here because QQQ is the most sensitive part of the tape when yields rise. Oil relief helped risk late in the week, but hawkish Fed pressure still makes long-duration growth prove itself. If QQQ reclaims resistance with better participation, it pushes against the pullback, first red in SPY. If it fails here, the next chapter on Treasury yields becomes the pressure point that explains why leadership is struggling. The 10-year yield is the pressure point behind the QQQ hesitation. Price is still elevated, but this is not a clean breakout yet. The resistance line is the decision area. If TNX cannot reclaim and hold that upper side, the rate pressure trade starts to cool. That would give growth stocks some room, but only if the support line actually starts to give way and yields stop finding dip buyers. RSI is still above 50, so the yield trend is constructive, but it is cooling instead of accelerating. MACD is still positive, but the histogram is cooling too, and that tells me the upside impulse is losing some force. The Fed minutes kept the rate backdrop uncomfortable, while late-week oil relief helped yields ease from stress levels. So the market is stuck between hawkish policy risk and de-escalation relief. If yields reject here, the SPY pullback first read gets delayed. If yields reclaim resistance, valuation pressure comes right back into QQQ and the broader tape. The cleaner trade map is the retracement zone. TNX has an impulse leg from roughly 3.95 to 4.69, so a pullback into the 4.23 to 4.40 area can still be bought by yield bulls instead of treated as a full breakdown. If buyers defend that zone, the first upside test is back toward 4.69, and that would keep pressure on long-duration growth. If TNX loses 4.23 instead, the yield squeeze weakens, and that is the better backdrop for equities before we move into oil as the next inflation driver. Crude is the inflation pressure valve here, and right now the chart still leans vulnerable rather than cleanly bullish. The 50 days moving average is the first problem. Price pushed into that area and got rejected, so buyers have not reclaimed control yet. The support line is the level that matters next. If it gives way, the oil relief trade can extend lower and take some pressure off yields. The 200 days average is still below as the broader trend floor, so this is a correction inside a larger structure, not a confirmed long-term reversal yet. RSI is near 50, so momentum is balanced. That means the next price break matters more than the indicator by itself. MACD is fading below zero, so crude still needs a stronger reclaim before I treat this as a clean bounce setup. The volume layer is worth checking here because participation is near average. This is not panic selling, but it is not a major accumulation surge either. Geopolitical risk is still the macro driver. If US-Iran de-escalation hopes keep holding, oil can stay heavy. If that story reverses, crude can quickly put inflation pressure back into the bond market. The higher stakes pattern is the double top. Crude rejected around 110 twice, and the neckline sits near 88.66, so sellers have a clear trigger if price closes below that area and holds there. A neckline break would make a retest common before continuation, with the measured move pointing towards 67.12. The bearish read weakens fast if crude reclaims the upper failure area, and a close back above 116.62 would invalidate the pattern. That is the handoff to Nvidia. If oil keeps cooling, yields get help. If crude reaccelerates, the AI trade has to fight the inflation channel again. NVDA is still the AI bellwether, but this is a strong trend that is already extended. The Golden Cross regime is intact, so I am not treating this as a broken leadership chart. The 50 days moving average remains above the 200-day moving average, and that keeps the larger trend structure constructive. But price is still far above the 200-day moving average, so the market has to earn the next leg with confirmation, not just AI enthusiasm. That matters after the oil and yield chapters because lower macro pressure helps, but valuation risk does not disappear when the leader is already stretched. The actionable level is the support line. NVDA is testing it, but it has not broken cleanly yet. Price is still above the key moving averages, so for me this is more of a bounce zone than a confirmed breakdown. The SMA FIDI matters because it is held for more than a month, and losing that cushion would make the pullback first read across the broader tape more serious. The 200-day moving average is still lower and rising, so the longer-term AI trend remains intact unless sellers start doing real damage. RSI is near 50, which tells me momentum is balanced rather than clearly bullish or clearly broken. MACD is fading below zero, and that is why buyers still need price confirmation before I call this a clean upside setup. Now look at participation underneath the move. Volume is near its 20 days average, so this is not panic selling, but it is not strong accumulation either. If support holds, the cleaner path is a bounce back toward the middle or upper side of the structure. If NVDA closes below this area, the AI trade starts reinforcing the broader pullback risk instead of fighting it. That is the handoff to Microsoft, because the next question is whether mega-cap AI leadership is broad enough to stabilize the tape beyond just Nvidia. MSFT is not giving a clean direction yet, but the setup is getting tight. The squeeze has been active for 3 days, so volatility is compressed, and the next daily close outside the bands matters. A bullish break needs a close above the upper band, with the recent range high around 433.70 as the first upside target. If the break goes the other way, I am watching the 50 days area near 400.44 first, then the range low around 356.28. After NVDA, this matters because Microsoft can still stabilize mega-cap AI leadership, but it has to break out of compression instead of drifting sideways. The key issue is that MSFT has reclaimed the 50 days moving average, but it has not cleared the bigger trend test yet. Price is still around the middle of the current support and resistance structure, so this is a decision zone, not a confirmed breakout. The resistance line is where sellers can still press. Until buyers reclaim that area cleanly, I still lean toward rejection first. The SMA 200 is the larger overhead test, and that is the level Microsoft has to deal with before I treat the recovery as a real trend repair. RSI is near 50, so momentum is balanced. That does not kill the bull case, but it does mean buyers need price confirmation. MACD is fading below zero, so the chart still needs a stronger push before this becomes clean bullish continuation. Now look at participation underneath the move. Volume is quiet, roughly 0.6 times its 20 days average, so the reclaim still lacks conviction. If MSFT breaks resistance with better participation, it helps the broader market argue that mega-cap leadership is broadening beyond Nvidia. If it fails here, the pullback first read stays alive going into the macro calendar. Now the calendar is where the whole setup gets tested. After Microsoft, Nvidia, yields, and oil, the market needs an inflation check that either supports the relief trade or brings the pressure back. Thursday, May 28th is the key date, with core personal consumption expenditures price index month-over-month and year-over-year both due at 12:30 p.m. That is the Fed inflation test. The prior monthly reading is 0.3 and the prior yearly reading is 3.2, so traders are watching whether inflation is cooling enough to protect the risk on tone. If core PCE comes in hot, then the rate pressure story stays alive. Yields confirm again, the dollar can stay supported, and growth leadership may have to absorb another valuation hit. If it cools, then the cleaner read is softer inflation pressure without immediately breaking the growth story. That gives buyers more room to defend the trend and argue that the pullback stays controlled. For me, this is not just about one inflation print. It is about whether the market gets confirmation that oil relief and calmer yields can continue working together. So the two-path setup is simple. Cool inflation plus steady risk appetite gives buyers room, sticky inflation, firm yields, or weak demand keeps the retest risk alive into the conclusion. The market is strong, but it is not giving me a clean chase signal here. Again, last week we talked about confirmation through the close, and now that warning matters more because price is stretched and buyers still have to prove control. The overhead resistance cluster near 749.5 to 755.3 is the first decision area, and I would not blindly chase into that zone without a clean close. RSI at 68.8 still says momentum is firm, but it is also close enough to hot that sloppy upside follow-through can turn into rejection fast. Again, MACD rolling over above the zero line keeps the trend alive, but it also says momentum is no longer accelerating cleanly. The open gap below around 725 to 727.8 is still unfinished business, so the tape is not just a simple upside story yet. Again, the macro driver does not replace the chart levels. Oil relief helped risk late in the week, but hawkish Fed pressure and elevated yields still raise the cost of being wrong. VIX is calm enough to keep trend continuation possible, and ADX still says the structure has strength. But strength and stretch can exist together, and that is exactly why I care more about the close than the intraday spike. From here, I am shifting this from what happened this week into the exact thesis map I am tracking next. The path I am tracking first is still one more pullback before buyers get the better chance to regain control. The first support cluster around 741.5 is the reaction zone I care about most if sellers press first. Again, if price trades into 741.5 and cannot bounce straight back above it, that pullback first regains confirmation. The open gap below around 725 to 727.8 becomes the next magnet if sellers keep pressure on and buyers do not respond quickly. Larger downside risk starts opening up if that first support shelf breaks and price keeps accepting lower. The secondary support area around 691.7 and the lower 689.9 to 693.4 zone is where I would start looking for the larger repair reaction. Again, that does not mean the uptrend is broken automatically. It means the market has to repair before the next clean upside attempt. The upside alternative is that buyers defend the 741.5 area, keep the broader uptrend intact, and start working back toward resistance. The resistance cluster around 750.8 is where that upside attempt has to prove itself, not just touch and fade. The 20-day swing high around 749.5 is the line that would invalidate the pullback first read if price closes back through it instead of trading lower first. Again, bulls have a real path, but they need closing confirmation through the upper resistance area, not another spike that gets sold. Support around 741.5 decides whether the reset stays controlled. Resistance near 750.8 decides whether buyers actually take back the tape. Do we get the gap and go, or do we fill the gap first? That is the whole trade map into next week. That is the full weekly read. Watch the key support and resistance zones, respect the macro pressure, and let the close confirm the next move before chasing it. Thanks for watching, stay sharp, and I will see you in the next market recap.